On this episode, I speak with Jim Puplava. Jim is a seasoned asset manager and financial professional who has been interviewed by the Wall Street Journal, ABC News Nightline, the Wall Street Transcript, the Huffington Post, and he even was in a documentary film called The End of the Road: How Money Became Worthless. Jim and I speak about the government shutdown, where he sees our economy heading, cryptocurrency, inflation, and how rents will affect the value of homes. Listen close as Jim shares his financial wisdom and insight as it relates to million-dollar mortgages.
Welcome to the $1 Million Mortgage Experience podcast. Listen in as CEO Jon Maddux of FundLoans reveals tips, secrets, and origination ideas to fill your pipeline with million-dollar opportunities.
All right, Jim, thanks for coming on.
Well, thanks for having me, John.
So you have a podcast yourself, right? And you talk about finances and economies and things like that. Tell us a little bit about what your area of specialty is.
Our area of specialty, we have two companies. We have our own broker-dealer, and then we have an RIA that manages money. And we call ourselves Financial Sense Wealth Management because we do total financial planning. In addition to managing money, we take care of things like putting together a plan, looking at taxes, estate planning, funding college, weddings, bar mitzvahs, etc. And so that's the basic company. I was an RIA for a long time. And then in 1995, I basically started my own broker-dealer. And the reason I did that is we were doing stuff that was kind of out of the box. The industry was going to what I call packaged products, mutual funds, and it's now morphed into ETFs. We were actually picking stocks. We were doing individual bonds. Mm-hmm. And most brokerage firms don't want their guys doing that. You know, they want you in a set area, stick with this. It's easy to manage when you have thousands of brokers.
Right.
So we started our own broker-dealer. And I used to do local radio, did television for a while. And then one day, the guy that my studio engineer, he said, "You got a website. Why don't we just put this thing on your website?" I thought, "How do we do that?" And he said, "Well, I'll just record it." And we loaded it up to the website. So that's sort of where we started. Mm-hmm. You know, people were listening to my show on their computers, or they were burning it to a CD, mm-hmm. listening to it in their car. And then, of course, when the iPod came out, you know, we just quickly moved over to the podcast side.
That's great.
So we do a number of programs. We do Lifetime Income, which is all on retirement planning. It's a subject program on Mondays. Mm-hmm. Tuesday, I interview somebody. Like this weekend, I'm going to interview the head of Social Security.
Wow.
And so we'll talk about, you know, what are the best Social Security moves. And we also talk about health. I've talked to some of the best doctors in the country. And so we cover issues of health, because if you're retired and you have all this money, but your health is no good, you don't have time to enjoy it. And then what we do is we have another program where it's called Insider. We interview some of the top minds on Wall Street, and they're in-depth interviews. That's a subscription. And then the weekend show is 2 hours long. The first hour, we cover the markets. I usually have a Wall Street technician, some of the great ones. And then we also cover markets from currencies to interest rates to commodities. That's the first hour. And then the second hour, I call this my big picture, is kind of taking a view of what's going on at the 40,000 foot level. Mm-hmm. What does this mean? What's going to happen next? And kind of sort of try to look out in the future, right, the way things will unfold. So that's, in a nutshell,
that's
what
great.
we do.
Things are going well?
Things are going well. Right now, we're very defensive. Mm-hmm. And we're probably going to be defensive for a while. We think there's another downturn in the market coming in the next month. Okay. And then we'll get what I call the last hurrah, one more big upswing in the market. Yeah. Because we're looking at a possible recession next year.
Okay. In an election year.
The only thing that could prevent that, because we always ask in the back of our mind, okay, this is what the numbers are telling us, this is the direction. Then we always kind of stand back and say, what could change that? So the president wants to get reelected, right? And Democrats want to get reelected. Sure. So let's say they can come up with some compromise on infrastructure. So they pass a $1.5 trillion infrastructure spending bill. Well, that would be another stimulus, just like the tax bill was a stimulus, because the $300 billion in spending that was passed in January of last year, that money runs out by September of this year.
Yeah.
So
it's coming, ticking time bomb, kind of.
Yeah. So, if you want to get reelected, any president knows, and this, what kind of strikes us about President Trump, he's the first president since George H. Bush that began his office with a Fed rate-raising cycle instead of a Fed lowering cycle. Obama began, Fed was lowering interest rates. George W., lowering interest rates. Clinton. The last one where you raised interest rates and it led to a recession was George H. Bush. Fed started raising interest rates. We had a recession in 91. He lost the election.
Wow. Yeah. There's a lot of stuff going on. Speaking of that, what do you think of this shutdown that's happening? It's the longest one in history, and right?
Well, it's the longest one in history, and it's interesting, John. On the day you and I are talking, the president's budget chief came out and said we could get a negative print in the first quarter for GDP, because every week that this goes on, it costs the economy 1/10%. So it's costing $2.5 billion a week, the more that's going on.
Jeez.
And, it looks like both sides are recalcitrant, and they don't look like they're backing down.
No.
President wants this wall. They don't want to give it to him. So it's kind of like they're
Showdown.
locked. The horns are locked. Showdown. At Washington Gulch. So,
what has Trump done in the past when he gets his back against the wall like this? Is there like history to show us anything like that? Or
I mean, he's a shrewd negotiator.
He likes to make deals, but
he likes
he's
to
also
make
shrewd and
and he can always play around you and get to that point. So, I'm optimistic that we see three main risks this year. The first one at the top of the list is the Fed makes a policy mistake. We have a saying on our show that the Fed will keep raising interest rates until they break something in the economy or the market, sometimes both. Second risk is the trade war. And the third risk is political discord. We're seeing a good example of that right now with the shutdown. The Fed basically has gone on pause. I don't think they're going to stay there unless the numbers really get bad, because we could see an inflationary surge in the second half, which is going to be related to oil. But the Fed right now
that's interesting you say that, because we haven't seen much inflation in a long time. I mean, and how long has it been?
Oh, it's been well over a decade. I mean, you would have to go back to probably 2007 and 2008 when oil was heading to 150 a barrel.
Right.
Where, we got CPI close to 4 or 5. We're barely holding 2 at the present time. So we could see an uptick as we were last year as the oil prices went all the way up to 77 and then back down in a short period of time. So the Fed's on pause. That's market positive, and the market has reacted to that. The second thing is the trade deal with China. We're the buyer of last resort, and Trump knows that. So if you're negotiating with the guy that's selling you a lot of stuff and you're the buyer, you probably have a little bit more negotiating power.
True.
And China's economy is slowing down. They're trying to re-stimulate their economy. The best thing they can do is reach a deal with the president, because that's hurting their exports.
Right.
So that could be resolved in the next couple months. That would be positive. The big unknown to us right now is political discord. How far do you push this?
Right.
Because this is not just 800,000 government employees now. These are a lot of small independent businesses, even big ones, that are contracting with the government that simply aren't getting paid right now. Loans, SBA isn't making loans. Right. So, this is starting to impact the economy.
Yeah, because there's a lot. I mean, I have a friend that his whole job is, it's not like the movie War Dogs, but he does other things like pencils and paper clips, and he contracts with the government. He's not getting paid. So there's a lot of people beyond the 800,000 that are totally being affected in their day-to-day job. What do you think that number is?
Oh gosh, the Wall Street Journal has done just a number of stories that have come out in the last 2 weeks. Last week they did a story about a company that was contracting with the government. They're about to open up their second plant. They're going to hire 160 employees. All of a sudden, pay stop, no cash flow.
Right.
So what do you tell a bunch of employees you just hired that are going to work in this new plant you're building? They're going to have to furlough them.
Yeah, that's scary.
Yeah, it's scary. So it's starting to hit. I would really be surprised if this continues into February or March, that you're going to see some defections in the ranks of Democrats. There were a lot of Democrats that got elected in red states that they've already kind of hinted, hey, we don't like this. We were sent here to do something.
Right.
So he's going to need some defections, and I think he's going to try to work on that. What can I give you? He's a deal maker. What's in it for you? Okay, here's what I'm willing to give you. Will you give me this?
Right.
But I would suspect by the time we get to March, I'm in the financial business. We look at the futures market. A lot of the data that we look at on economic information, we're not getting it right now. So
it's kind of running blind then.
Yeah. I don't know what the commercials are doing right now because I'm not getting reported on.
Right. And that must affect your analysts all around the country, right? I mean,
you're looking at and you're just trying to gauge. We were talking to Moody's Analytics last week, and they said, this 1/10 of a week. And I asked the guy, I said, what is your best estimate of when this gets solved? He said, this will go beyond the first quarter.
So when Trump says it could last months, if not a year or more, I mean, you think that's possible?
I would say the closer we get to election year, I think you're going to see him tweet and do something that changes that. Because a good example was last June, he said he was walking away from the Iranian deal. And he said by August 6th, if they didn't come up with something 90 days after August 6th, sanctions were going to go in effect. 2 million barrels of Iranian oil were going to be taken off the market. So what does he do? He tweets, Russia, Saudi Arabia start pumping a whole bunch of oil. We get to November 5th, and he goes, oh, by the way, we're granting waivers. And so the price of oil plunged. So, he's pretty shrewd. He says he's a business guy, but he's a shrewd politician, too.
True.
No president wants to go into an election year with the economy in recession,
right,
the unemployment rate rising, the stock market falling. That's deadly.
Yeah. Yeah, he wouldn't do that, I don't think, either. So our viewers, they're mortgage brokers. They're kind of entrepreneurs because they run their own business. You're an entrepreneur. You have your own business. How'd you get your start, and how did you get how did you create your own success, would you say?
Gosh, I had this entrepreneurial bug that, goes back to when I was in second grade and had my first paper route. I had a lawn mowing business. I had a paper route. I grew up in Phoenix, Arizona, where the neighborhood I lived in, you basically watered your lawn through irrigation. So I had an irrigation business because nobody wanted to get up. If your time to irrigate your lawn was at 1 o'clock in the morning, I was there. 1 o'clock in the morning, I did it.
How old were you when you did that?
Oh, gosh, I was in grade school.
Wow. So you were up that, your parents let you stay up that late?
Oh, yeah. Yeah. That was the only time I got to stay up late. And so I started that. And then in high school, I had various jobs, my lawn mowing service. And then when I got out of the Army, I started valet parking. And then I started my own valet parking business for a couple upper end restaurants. So I put myself through school. So I went on to graduate school. I spent 3 years in corporate life, and I don't know. There was something about it. It was too confining. So I went off on my own, and I always had to love the markets, and started my own business. So I just one of those guys that always had these ideas of how to make money, and I like being my own boss, setting my own hours, and having your own business, the hours you have to put in to make it go.
Yeah, it's so funny. You kind of trade a 40-hour work week for a 60-hour work week. But you're doing what you love, right? You're doing what you love, and then if you make a success of it, you reap the rewards of that. True.
Versus corporate life. And so I I guess this goes all the way back to I was a little kid. It was just the way it was. I just had this inkling to do things.
So you found a niche in something, right? Is your business kind of a niche, or do you have a broad stroke, would you say?
No, I found a niche, and I go back to follow the money. So when I got in the business, it's like, who had the money? Well, It was retirees. They worked all their life. They accumulated a bucket of money.
Right.
Well, if you're going to be in our business, you want to manage money, you want to go where the money is. And so I developed an expertise, and I think it was 1981, I got my CFP, which is Certified Financial Planner. And I began working in the retirement market. And so we're doing that, and we've been doing that since 81. And then 85, I moved to California to start a business. And then in 95, I basically started my own broker-dealer. But the other market we're going to go after now is the 401k market. Because the 401k market, what we're finding, especially now in let's say, the boomers, the Gen Xers, a lot of their wealth is in two areas. It's either in the equity in their home, or it's in their 401k plan. And so a lot of people put their 401k plans on automatic pilot.
Right.
You sign up with the company, you pick your funds, and you forget about it, and you put the money in.
Kind of check it every now and then. So, I'm making money.
Yeah, making money, or you don't want to look at it when the markets are going down. So we want to go after the 401k market, because if we can help people better manage that during their working career, well, they're going to have more money when they retire.
Right.
So it's going to be sort of a niche outside of retirement. I call it the pre-retirement market.
Right. So have you always kind of looked for out-of-the-box type of things? I mean, our loan products are all outside the box. Like we're non-institutional, we're non-agency, and a lot of our borrowers and our viewers are people that look for kind of like follow the money, like you're saying. Like it's like, if the rates aren't low, then the loans aren't falling out of the sky, and they're not low-hanging fruit, but they're loans that you got to go look for. You got to kind of get off your butt and like do something. You got to learn some new products. You got to like find out where the need is for this stuff. Like what kind of advice could you give to someone like in that position where the rates are different now, and so you got to kind of figure out a new way to make money?
Yeah, we like to think outside we've always thought outside the box, because we just like to do different things. We actually pick stocks. We actually buy individual bonds, because we can cherry pick and go in and find unique situations that can help the client. So, if you're in a mortgage broker, you're in the real estate market, always start thinking of what other people aren't doing.
That's good advice.
And find out what is a niche that isn't being served, or nobody's paying attention to this niche of the market, and then find that niche.
That's good.
And like when I started, it was retirees.
Where do you think the market's going now as far as economy? I know we talked a little bit about that, but like, where do you see rates going up anymore? Do you see, I think you said there's going to be a potential recession in election year possibly. But what do you think you said there's going to be one more kind of boom, and then, and then it kind of settles. What do you think what's going to drive that?
I think, going back to my risk. Okay, so if you take a look at what sort of started the sell-off at the end of the year, if you looked at the economic numbers last year and look at where the forecasts were, we just got a $1.5 trillion tax stimulus. We got a $300 billion government spending stimulus. So if you look at 2018, the economy started heating up beginning right from the start of the year. We got up to a 4% growth rate. Corporate earnings were coming in at 25% per quarter. All of that, if you were to look at it from the surface, was looking really good. Economy was growing at the fastest rate in 10 years. Corporate profits are up 25% a quarter. If you cut tax rates from 35 to 21, you're going to get increased profits. But what happened is in September, the Fed has an FOMC meeting and says, oh, by the way, we are far from neutral, which was an indication to the market. 1 week after that, the market started selling off, because people started analyzing, what did he say? What was he meaning? Well, we're going to be more aggressive. And then he had another meeting in December when they raised interest rates a quarter of a point in the press conference. He said QT, which is quantitative tightening, this is letting $50 billion a month roll over. He goes, that's an automatic pilot. We're going ahead with that. Market did not like that. So we went from an economy that was still growing, corporate earnings that were still coming in, to everybody started saying, oh my goodness, this is going to start slowing the economy. The Fed's going to do what it always does. And so we had the sell-off. So we ended up the year negative. So nobody, if you're looking at January 2018, nobody would have saw a negative year. So now we're at 2019. And the Fed is saying the overseas markets are going down. They're seeing the economic numbers from the ISM, manufacturing, service numbers go down. All of a sudden, Powell is kind of like, I call it the open mouth committee. They're out there talking like this, and they're saying, oh, okay, we're going to relax. So this next upswing, if you get a Fed on pause, which the market likes, and let's say Trump negotiates a deal with China, so the trade conflict goes away, that would be a catalyst for an upward swing in market. But another factor that's going to come in is the rise in oil. We think oil prices are going up for a number of reasons. Number one, they're overstated in terms of the inventory levels.
They've been low for a while, yeah.
Yeah, it's not like they have a dipstick and it's a precise science and they put it in the can. Okay, that's what the inventory is. But China, most people don't know, was buying 500,000 barrels of oil a day. So during the trade conflict, they backed off. So there's 500,000 barrels that aren't going to China anymore. So they just indicated they're going to buy more soybeans. If they reach a agreement on trade, they start buying 500,000 barrels of oil or more oil from the U.S. And you've got Saudi Arabia and Russia. They're saying, we're not going to get full this time. Saudi Arabia needs $80 a barrel.
Yeah.
The other thing is, if you look at the shale plays, the cheapest shale play is the Permian Basin. They need $51 a barrel to break even and make money. Well, already we're seeing CapEx expenditures drop. We're seeing the rig count drop. And sooner or later, there's a saying in the business, the best cure for higher prices is higher prices. The best cure for lower prices is lower prices. So you could see in the back half of the year, right now, the futures market, and we don't have up-to-date figures as of the shutdown, but they're pricing in the next rate hike coming from the Fed would most likely be June. That's if things turn around, and I'm assuming also the government shutdown doesn't go that long. If the government shutdown goes that long,
who knows?
Yeah, who knows? So let's say the Fed raises interest rates in June, oil starts to go up, and the futures market has the next probability, maybe December. But you could start to see rates back up again. And the problem, John, now is we have a lot more leverage out there. And the area I'm most concerned about is the corporate debt market. And it's up 60%. And the characteristic of it, if you take a look at BBB rated bonds, $750 billion in 2010, today $2.7 trillion.
Jeez.
So you've got 2/3 of the corporate bond market is junk or BBB rated, just one notch above junk.
What would cause that to just collapse?
It would be a recession, a weakening economy, because what happens in a weakening economy, company sales go down, their profits go down, their interest coverage ratios, and what does the rating industry do? You look at a company that was BBB rated in good times, and bad times when things are shrinking, they get downgraded.
Right.
And if they get downgraded, that could cause a shockwave, because you've got literally hundreds of billions of dollars of mutual funds and ETFs that are investment grade, meaning their mandate says you cannot own anything that's low quality, which would be BB. So if a BBB rated bond gets downgraded to BB, you're mandated, you are forced to sell that.
Wow.
And so if everybody owns the same stuff, it's like you and I are the owners of the market. Okay, we have to sell. I can't sell to you because
the buyers shrink, then the amount of the demand for that stuff is gone, right?
Yeah, the demand shrinks, liquidity disappears, and there's only one thing that brings liquidity back in the market is price. Right. So the price drive is driven down far enough that somebody will look at that and say, hey, that's distressed debt. There's been fortunes. Howard Marks.
Well, it kind of reminds me of what happened in the housing market when there was way too many houses built, right? And there was the glut of homes that were on the market, and then the prices dropped, and then all of a sudden the big hedge funds like Blackstone, BlackRock, they all went and bought all these properties, and they stole them. They got them for pennies on the dollar, and they bought the distressed debt, the distressed mortgages, and they just cleaned up and they held on to it, and now they still own it. A lot of these hedge funds still own a lot of these houses, and they're making a killing because rent is so high. Yeah. So how do you think this kind of all compares to possibly, the housing market and like where we're at today in the housing market?
I think in this next downturn, you're going to have a similar opportunity. And this happened also in 1991 when we were in a recession, the S&L crisis.
Yep.
And I'm trying to think of the government agency that was set up to liquidate all these loans. And there's a couple guys here that became billionaires in California by buying all that those distressed mortgages. So the next downturn, you're going to have an opportunity to buy not only distressed debt, so a lot of this double B debt, because what happens if the economy turns around, the double B gets upgraded.
Right.
So you'll be buying angel bonds, they'll get upgraded, but you'll be buying them for 60, 70 cents on the dollar, and the economy turns around. There's going to be a lot of fortunes made.
Yeah, because it doesn't mean that the businesses are going to go under necessarily. It just means that the debt itself is now less valuable. Is that right? Or
yeah, it's like there is some greater risk there. Obviously, a double B rated bond isn't as safe as something that's rated AAA. You don't worry about it. So, but in a downturn, it gets downgraded double B, depending on the nature of the business. But then when things turn around, and you get the next reinflation, we see the next cycle being as inflationary, which also implies higher interest rates.
Right.
So, because the next time they're just going to come in with massive fiscal stimulus and the Fed's going to monetize it because there will be no choice. I'll throw out something that, if you look at it, it's kind of scary, but if you look at what they might do, then it isn't. By 2020, interest on the debt will equal more than what we spent on Medicaid. By 2023, interest on
talking U.S. debt, right?
U.S. debt, yeah. By 2023, it'll exceed what we spent on the entire defense budget.
Jeez.
By 2025, interest on the debt will exceed all discretionary government spending outside of Social Security, Medicare, and Medicaid.
Wow.
So what do you do if you're a politician or you're president in 2025 between entitlements and interest on the debt? There's no money to run the government, pay the FBI, the Supreme Court. What you do is you spend money and the Fed just comes in and monetizes it. Kind of what we saw them do with QE and what we saw the European Central Bank do.
Wow.
And so I see an inflationary cycle going up in the...
Do you think that'll keep interest rates down somewhat? I mean, if the interest rates go up even just a little bit more, the amount that we're paying on that debt is just continually rising, right? I mean, so there's got to be some pressure to keep those rates low, right?
And that will be the Federal Reserve, but the market gradually, we see interest rates rising. There's a gentleman in our business who we sort of refer to him now as the current bond king. And he's analyzing this perspective is typically when you go into a recession or you see economic weakness as we did in the month of December. What happened last year is sort of a prelude to what may happen in the future. If you look at the downturn that came in February last year, the month of January, stimulus, the spending bill, every single week the market's going up, hitting new records. In 1 week in December, we gave everything back in 6 days.
Yep.
And what did not happen in typical market downturns, the Treasury market did not respond. In other words, you lost money if you were in Treasury bonds, as you did in stocks. Fast forward to October, the market starts to roll over, Fed comments, stock market goes down in the month of October, bonds go down in the month of October. So you're losing money in every asset class, commodities, bonds, stocks. It started to flip in November as people started saying, oh, wait a minute, growth may be slowing down. And all of a sudden the Treasury market, which was 10-year note was at 3.25%, started to go below 3%. So so that was a little bit more of what I call the safety trade. It flipped back to that safety trade, but in February and October it wasn't. It wasn't working then. So the interesting thing that comes in is if we go in another recession, we're running trillion-dollar deficits with 3% economic growth. What does that deficit look like when you get into a recession?
Right.
You could back up to 1.6, 1.7. Then you also have the Fed pulling out $600 billion out of the market. So you have three big buyers of federal debt. You've got the Fed, you've got China, and you got the Bank of Japan. Japan's pulling back, China's not buying, and the Fed is shrinking its balance sheet. What do you do when you start getting to $1.6, $1.8 trillion of deficit where you're flooding the market with a lot of debt? In a recession, maybe this time around, and this is just out of the box stuff right now, but maybe this time around rates start to rise because there's an enormous amount of debt that's coming into the market. Who's the buyer?
Very interesting.
Yeah,
That's
so
the trillion-dollar question.
the trillion-dollar question. Yeah,
So
or
what-
$2 trillion question.
Yeah, exactly. What do you think? There's a lot of talk, not as much today, but like months or so ago about cryptocurrency and Bitcoin and how that was up and then it crashed. Do you know much about that? Do you see that being having any impact on this?
It's not, if you look at money, it's got to be a stable source of valuable. It's got to be fungible. I mean, you hear merchants taking Bitcoin, but how would you like to have given a merchant a Bitcoin at 19,000 and it's worth 3,600 today? I just don't think that's going to work.
How much money was pulled out of the market by that crash? There was a good number of billions, right?
Billions of dollars came out of the market, and interesting that I'm a believer in gold, and I believe gold is about ready to have its next leg up. And the thing with cryptocurrencies like Bitcoin, and especially with younger people, it was taking money out of the gold market because the millennials, their cell phones, technology, that just fit right in. I don't trust the markets.
Yeah.
And so it did defer and take money away from what is typically a safe haven in times of turmoil and turbulence, which is the gold market. And I think I see gold resuming that value because cryptocurrencies, how can you buy some for 19,000 and it drops to $3,600?
Yeah,
that is not.
There's a lot of people blowing money, partying, and then next day it was like it crashed.
Now, one of our guys that works for us got onto it early. Thank goodness he got out.
Yeah.
He got a Hawaii vacation out of it, but that's he hasn't gone back since.
So you like gold. What about, rents are really high right now. So there's a lot of people renting still, and there's the price of rent is high for residential real estate. How do you think that'll affect the value or the price of homes?
When you get into an economic downturn, you're already seeing it right now reflected where even some of the builders are throwing in the same thing they did in 2008. They're throwing in, more extras to get in the house. They're helping you on the... So, you're going to see those kind of things. But the one thing we didn't see this time around, John, is that we didn't see oversupply. We didn't see ninja loans, no-doc loans, none of the crazy stuff.
Still tough to get a loan, yeah.
Yeah, still tough to get a loan. And builders were very circumspect on building. I can remember in the housing boom where builders would open up, phase 1, 2, or 3 building spec homes
All at once, yeah.
All at once. They didn't do that this time. We open up phase 1 when we got everything sold. We'll open up phase 2.
Right.
So I think prices will weaken. But are they going to collapse? I just never saw real estate getting into a bubble. The other thing you had, which was a result of what happened the last time. I have home builders are telling me that custom guys that it's hard to get. I built a home and it took 6 months longer because my builder couldn't get, the different subs. They were just overmatched.
There's a lack of good labor in the market.
Yeah. So not only did it take longer to go through the inspections, but, trying to get people to work on the house, was spread thin.
Right. So do you think, kind of what I've thought is there's going to be a little bit of a softening, that it might be like a 2001 type of softening, and then then it might continue to stay stable and go up again. I mean, what do you think?
I think it'll soften, stabilize, and then rise again. But I think it's going to be the next upswing. I think is going to be more regional. It's going to be. I mean, you take a look at this tax law. If you live in California, it's one of the most expensive places to live.
Yeah.
What did you just lose? You can't deduct your state taxes. You can't deduct your property taxes anymore. Right. So all of these things are important. Plus, they just reduced the mortgage deduction down to $750,000 versus before it was $1 million plus $100,000. So I think you're going to see what I call the intermigration. You're going to see people from the East Coast and the West Coast, and they're going to be moving inward. Because you're seeing
a lot
with
of people
companies
moving to Texas. There's a lot of people moving to Arizona, Nevada. There's a lot of people moving to Colorado. I know a lot of people that have moved there from California, and I'm sure it's on the other side too, right? New York, there's people moving, and then the East Coast,
Florida, and North Carolina, and places like that. And I would say maybe a little over 25% of our clients here in California, they're retiring, they're moving, because I can sell the big house here that's worth over $1 million and
pay cash for another house and then have extra. Yeah.
Our favorite joke is a definition of a California millionaire is a homeowner. So, but they can sell the house here $1 million plus. We had a client, San Francisco, small townhome, sold it for like 1.4, 1.5 million, moves to Reno. Pays cash for a house with a backyard this time for $600-something thousand. Right. And she's got a free and clear home and a backyard.
And then goes on vacation to California whenever she wants.
Yeah, she can just go to vacation. So we're seeing a lot of that where people are cashing out of the more expensive states, and we're seeing it also on the East Coast too. Yeah. New Jersey, New York, places like that are very expensive. On the East Coast, they go down to Florida. It's cheaper down there. Right. There's no taxes, and the cost of living. Here we're seeing people go to Nevada, Arizona, and Texas. Right. Some going to Washington, not as much, but. And
it's not just I would say it's not just the elderly, right? It's also there's a lot of job growth in these other states, and so there's people that are younger moving to these other states too. Is that accurate, or is it mostly the boomers or?
No, it's all kinds. I went to Reno in the month of August and just checking the place out. Toll Brothers has 20 projects they have online. They're going to bring, I forget, they own something like 20,000 acres. I mean, They're selling everything that they could have.
Well, yeah, Amazon's there, Tesla's there. Who else is?
Google just bought 1,300 acres next to Tesla. Amazon's got 2 fulfillment centers, 4 squares there. So,
they need jobs. They need people to live there.
Yep. And, they can't build them fast enough. Right. Because for those of us who live in California, you go to Reno and you go, oh my God, this looks cheap. Yeah, anything looks cheap compared to California. And so I see places like Texas, I see Nevada, I see Arizona where the cost of living is cheaper. The weather's not as good. Right. But, the money you save, you can vacation here.
Yeah, so true.
Yeah, so I see it more of a regional play in the next upcycle. Because do you really want to buy a medium price home in San Francisco for $1.3 million? Yeah. And we're not talking McMansions there.
No. Yeah, it's amazing what you get for 1.3 now. Yeah. It's not amazing. I should say it's underwhelming.
Yeah, I was just I'm trying to think of the name of the site. It's called Trending, and they were talking about Mark Zuckerberg, and he has something like a 5,600 or 6,000 square foot house, $10 million in his neighborhood. And, it wasn't a mansion. No. Yeah, but that's San Francisco.
It's so true. There's a huge demand with all the fires too, with all the fires up there and in the north of there and in the Bay Area, Santa Rosa. There was tons of fires, tons of people thousands of homes were burned. So, I mean, the fact that people were displaced, and then that didn't help that helped the housing market, but it didn't help, with the supply problem we had.
Yeah, I mean, you have to think, if you had housing insurance and you get reimbursed, do you want to buy another house in California, or do you want to go someplace where that money buys you much more?
True. Very true. So we talked about the government. We talked about economy. What a little bit about rates. Do you think, would you advise someone to get a fixed rate or an ARM rate? Or is there a difference in your mind, like that, or is it circumstantial? Or
I tell people there's two things. If you see yourself only staying in that house 5 years, 10 years,
right,
then I would get sort of like an adjustable, like let's say a 5, 7, or 10 year,
sure,
with a fixed rate.
Right.
That way you get a lower rate, it's fixed, and what you don't want to do is what happened to all those people that bought those special loans in 2007 and 2008 when they got adjusted upward. Basically they couldn't afford to keep and stay where they are. So you got to take a look at your budget and take a look at, answer number one, how long do I realistically think I'm going to stay here? If you're planning a big family and it's a small house, well, you're probably not going to stay there long.
True.
Secondly, if you only see yourself maybe staying in the area 5 to 7, 10 years, then you get a loan in that range.
Right. Makes sense.
But I prefer fixed because, like I said, the big unknown is what's going to happen when the government starts to run out of money, the Fed starts to print money, and what's going to happen in the next upcycle. And that is sort of a big unknown right now.
Well, yeah, I mean, I always look at these charts of like housing over the last 100 years, and you see, you always see the little crashes or the little dips, but then you see, even a 5-year-old could tell you, well, yeah, housing always goes up. So, I mean, I think a lot of that has to do with inflation over years, right? I mean, and so if we think about that and we think, well, at some point, Fed's going to have to print a ton of money again. There's going to be inflation. The dollar's going to weaken at some point. Then it just makes sense that house prices have to go up at some point. So if you did get a 30-year fix, kept the house, even if you were going to move, maybe rented it out because rents are still staying high, that might be a smart economic move for somebody.
Right now, I see in the next decade interest rates rising.
Yeah.
So if you're a real estate investor, locking in a rate, so you know what your cash flow is going to be.
Right.
Or if you're a homeowner, just locking in a rate for how long you think you're going to be in that house. If you're 55 and you're thinking of buying a house and you're thinking, well, when I turn 65, 66, am I really going to stay in this house when I retire? Well, maybe you only want a 10-year mortgage.
Yeah, makes sense. So last question I like to ask is, you've been an entrepreneur, you've had ups and downs. Every successful person's had failures in their life. What would you say your favorite failure was throughout the years?
Not holding to my conviction. This was a painful lesson. In 93 and 94, we were going through, at that time, they called Hillary Care. And what happened is when that was going in, when they were talking about legislating it, a lot of the drug stocks were just hammered. I mean, they were down 20, 30, 40%. So, I went in there and I was picking up companies like Merck, Lilly, Pfizer, and getting dividends of 4.5%, 5%. And it almost got passed. So after I buy it, I'm picking them up cheap. The dividend yields are good. And then all of a sudden it looks like, oh my goodness, this could get passed. And the markets react to it. So, I lose another 20%. And I'm reading, the media picks up on the current stuff. Oh my God, this is going to get passed. This is going to be doomed for the drug companies. And then my clients putting pressure on me. And I sold them. And then I had a client, a rather large client. He came in and he pulled his account for me. He said, I want to tell you why I'm leaving. And I said, I've done good by you. He said, you bought good stocks and I was with you. I understood your rationale, but you didn't hold your ground. And so I lost a very large client, and it taught me a lesson because what happened? they went back up, and they were up several 100%.
Right.
So not holding and standing by your conviction, because we always tend to think outside the box.
Sure.
I mean, if you're a value investor, for number one, you're not going to find value if something isn't going wrong with the company.
Right.
Yeah, because otherwise you're paying prices like Amazon.
Sure.
So you've got to think outside the box, because that's how you're going to get them cheap. But you have to hold on to your convictions, and you got to say, but the same token, you have to know, okay, what would make my assumptions wrong too? Because
Sure.
a lot of times that's another mistake. Sometimes when you are wrong, you don't want to recognize it.
Yeah.
Your ego comes in, and there's something about, I don't want to admit I was wrong. So holding on to your convictions, I think, was a real valuable lesson for me.
That's great to learn. I mean, it's tough. I know it's hard to learn lessons sometimes like that, but they sure pay off when you learn and you change, right? And you stick with your convictions and going forward.
Yeah, there's a guy by the name of Ray Dalio who runs Bridgewater. It's the largest and most successful hedge fund in the world. And he has 5 goals, and one of them was set goals. Number 2, when you make a mistake, learn why that was a mistake. Number 3, learn how to correct it. Number 4, don't repeat it.
That's good.
So those were some early on lessons that had an impact on me.
That's good stuff. Well, Jim, thank you for coming on the show.
Well, it's great to be here. Thanks for having me, John.
Thank you for listening to our podcast. If you guys are looking for more content like this, we have a FundLoans YouTube channel where we give away more tips, secrets, and origination ideas. You can also email us at info@fundloans.com. And if you've made it this far, I think it's safe to say you like our content. So please subscribe, share, and send us your scenarios. Let's fund loans together.